Well, happy Tuesday. It is September 5th. Hope you guys enjoyed your Labor Day weekend. Want to share with you the latest data here in the Austin metro area. And this is a look at your September 2023 market trends. I want to start with some national data first. This was shared at our Keller Williams Mega Camp conference back in August. Again, this is national data. We're looking at annual home sales here on this slide. The dotted line here is where we're projected to end at the end of 2023, which is about 4.3 million homes sold in the US. You can see that the last time that we had that many homes sold was 2011. And really, that's kind of mirroring where we were at the bottom of the last housing downturn. So we actually had low interest rates back then. We just had extremely low buyer appetite. And more importantly, none of the major home builders were building homes back then because they got burned over here when we had that huge run up in home sales before the 2008 downturn. And you can kind of see that really vividly on this chart. Boom, huge crash, literally a loss of 3 million homes a year being sold from '05 down to '08. Then we've had a nice, steady, low interest rate environment, climbed up to the pandemic where we had 6.1. But even last year, we went down to 5 million homes sold in the US, over a million from 2021. And this year, we're probably going to be 4.3. In terms of home sales monthly, you can see the teal line is much lower than the purple line, and that's kind of a month-to-month look at that. Here's home prices annually. So if you go back to the last housing downturn, homes were pricing about 21% above this kind of 4%, 4% annualized interest rate, not interest rate, but appreciation rate climb. We got ahead of that and the market had to slow down. But then we were climbing nicely. We actually caught up to it. We have had the pandemic again, and right now we're about 7% above trend. So what's happening is nationally, we're still above trend. I would say Austin is cooling faster than some, and so we're seeing Austin correct faster. I think Austin's going to be first in, first out in whatever we're heading into, if this is a recession or just simply a slowdown. I think some of the other markets in the country might be a little slower if they are kind of slow and steady right now with their home sales. And then again, in terms of home prices monthly, again, you can see there's a decline. Wanted to show this chart to you as well. This is mortgage rates. So when we look at mortgage rates nationally, you've always heard the stories. Somebody in the 80s bought their home with 18% interest rates or some high interest rate. You can see that way over here on the chart. But from that date to today, nobody else has had to pay super high interest rates. What happened was once we got to the early 90s, interest rates started to come down. The bonds started to get cheaper as our national debt went up. And what's happened is since that time, if you look at the last 30 years, let's say 1990 to now, 33 years, our average interest rate in that period has been 5.97%. So even though we're sitting about 7.25 right now on the fixed rate, 30-year fixed rate mortgage for a primary home buyer, which is below the long-term trend, but it's a full point above the shorter term trend. And that's where we're seeing kind of some disconnect. The buyers today, obviously to them, it feels like they're paying a much higher rate than they thought they would have had to pay in the last 30 years. But of course, it's still lower than the long-term trend. But you can see that here, especially the last 10 or 15 years, we've been significantly below that 5%. The last time people were paying that was '06, '07. And before that, most of that was in the 90s. So that gives you a good look at mortgage rates there. And then finally, want to share this chart to you, which I think really sticks out. So this is all the mortgages that are in existence right now in the US. 89% of mortgages have a 5% or less interest rate. Who are those people? They're property owners. And so these are your sellers in the market today. 89% of them have a mortgage rate of 5% or less. How does that break down? 32%. 1 out of every 3 mortgages in the US is at or below 3%. Another 27% is 3.5% or lower. So just those numbers right there, over 50% of your mortgages in the US are 3.5% or lower, way below half of where we are today. Another 17% are just up to 4%. So you're talking almost 75% of mortgages are 4% or lower. And of course, it goes all the way up. The highest number they have on this chart is 6 to 7% interest rate. Well, where are we right now? And I'll show you in a second. We're over 7%. So if you're getting a mortgage today and you're paying at or above 7%, you're not even on this chart. So where's the disconnect? The disconnect is here's where the sellers think their property is worth. They're thinking, oh man, I know what my mortgage payment is. My house is hot stuff. I've only got a 3.5% mortgage, but they can't assume that. You can't sell it with that mortgage. The buyers are looking at it like, man, your house, I got to spend 7% to buy your house. It changes the equation of that property. This is where the pain is from a mortgage chart right here, is the fact that the sellers have low interest and the buyers have to buy the same house with a high interest rate. So let's look at what's happening in the Austin metro area. This is a look. The last full month that we have is July 2023. And so this is looking at that data more graphically. So now we've got all the July data in. We are the orange line here. And you can see we kind of peaked out in May in terms of number of homes sold. And since then, they've really dropped off hard. This was the late summer slowdown. More importantly, we've had high temperatures. Interest rates went at or above 7%. And we've had higher inventory, which I'll show you on another chart. And what's happened is it's just reducing buyer demand. And we've seen that in the numbers here. So that's number of homes sold. We see that in volume as well. Volume is what's the dollar amount trading, and we're seeing the dollar amount come down. But of course, you see that happens pretty traditionally at the second half of every year. All right, here's the chart, okay? Median sales price. This is what everybody asks about. So here's this maroon line here is 2020. If you look down here, this little dip right here was March. This is when COVID hit and they shut everything down and we saw sales drop. And April was the scariest, call it, moment of the pandemic when you didn't know what was going to happen and nobody could do anything. So we had home numbers drop and we dropped to a price of $325,000. So that's where we were at the beginning of the pandemic. And then, of course, you see where we ended up way up here at the end of the end of the pandemic rise with the low interest rates. We peaked out around 550,000 from 325. Huge run up, right? Well, what's happened since then? Interest rates went up. We've seen it come down. And this year as well, we had a nice little spring bounce. But of course, we're going to see as interest rates go up, price is going to have some more pressure. It's starting to come down. We're now just a little bit below 2021. So here's where the pain is and where the disconnect is in the market. If you are a seller, you're sitting here and you're frustrated because you know what your neighbor sold their house for up here, and you've been watching all these homes also get higher prices. You might have even watched the spring buyers get a little boost. And so you're frustrated because you want this. So that's where the sellers are right now. They're frustrated and they feel like they missed the boat. Sorry, you did miss the boat over here, but don't miss the other boat that you caught. The boat is you didn't buy your house up here, at least most of my sellers. They bought their house down here. And so if I take this number right here, 325, and I run it up to today's number, 462. So from April 2020 to July 2023, we have had a 42% appreciation rate, which annualizes to about 14% a year. I think if you talk to any homeowner in any historically normal time period, if you could get 14% a year on your house, you should be thrilled because you're unlikely to see that ever again. So sellers are frustrated because it's hard to sell a home right now. There's not a lot of buyer demand, and they know what homes sold for at the peak of the pandemic. But buyers aren't happy either. They're frustrated too. Why? Because they know what homes used to cost. They know what these sellers got to buy these homes for. They know the sellers have 3-4% interest rates, and they've got to come buy it at today's value with a 7% interest rate. So they're frustrated too. And so nobody's happy right now. You've got sellers that are frustrated because it's taking longer and it's harder to sell their house. The seller is also sitting on a 3 or 4% interest rate, and they can't wrap their head around why it's so hard for a buyer to have to buy their house. The buyers are frustrated because they still feel like they're paying way higher than they probably could have bought that house for had the pandemic not happened. And so it's hard for them too. So this chart right here really kind of shows the pain. I think this little dip right here is purely because we're having a low number of home sales and high interest rates. That's probably temporary, at least maybe the next 6 to 12 months. And then I think we'll see what happens when things start to level out. But this chart right here really tells a big story to me. Average sales price, we're seeing a very similar story. And total listings, this one's actually a little behind. I'd say we're up here at the 10.5 range. So we're kind of at the top of the chart. We're probably sitting about 4 months of inventory, give or take. If you're in luxury, it's much higher. And if you're in starter homes or in maybe some core neighborhoods in the city, it could be lower than 4 months of inventory. But generally, I'd say the market is about 4 months of inventory. All right, so this is real-time data. This is right now, this morning in the Austin Board of Realtors MLS. So the original price, this is a look at the original list price of a listing and the sold price of the market. So this is not a specific home. This is generally where are sellers kind of showing their hand with their list price, where are homes closing once they get to the closing table. So this was January and this was March right here. You can see that sellers were getting eager again. Hey, it's the spring. I want to list higher. But what happened was there was a huge gap between where homes were listing and where they were closing. This was a $90,000 gap. 530 they were listing and 440 they were closing. So there's 90% gap. What's happened is interest rates went up. Sellers got more savvy. They started to realize, look, I cannot overlist my house. I got to get competitive. So we've seen list prices go from 530 back in March. Today, September, they're trending about 479. So that's about a $50,000 adjustment in median home value that we're seeing sellers list their homes. But look what's happened with the closed prices. They're getting a little tighter. So we went from a $90,000 gap. Now we're about a $19,000 gap, which is much more normal. You know, it rarely is going to be equal unless buyers are consistently bidding over on a lot of homes. Typically, you're going to see a little drop from the list to sales price, but it's much, much closer, which means sellers have gotten more realistic with their price. Buyers also are having to compete a little bit on certain homes if the price is getting closer to reality because more buyers are willing to bid on it. So we're seeing that come together. All right, finally, let's go to mortgage rates. So this is as of this morning. This number will likely change. I've seen the 10-year Treasury this morning go up, so I think we're going to see. The mortgage rates go up today. But more importantly, we're kind of sitting in the sevens. If you're buying a home with any one of these loan products, you're in the high 6s to 7s, depending on what you're trying to use as a loan. And this will show it to you as a chart. Right here, average 30-year fixed rate. So the low end of this chart is 6.75% interest rates. We've been above that since June. This second line is 7%, and we've been above that since July 26. So we've been at or above 7% since July, which means late July, all of August, and now into September, we're at or above 7%. That is the number that all these buyers are having to talk with their lender and calculate purchases. So it just creates that downward pressure on the market. I do think we're now trending into the fall market. So what does that mean? Typically, there is a fall market. The weather gets a little better. People are back in town from all their summer vacations. It's more, and people that want to purchase a home before the end of the year are going to shop now, typically through about Thanksgiving, ideally a little before Thanksgiving, at least to get it under contract. So if you are a buyer right now, expect that you're going to see a little more competition. If you are a seller right now, your clock is ticking. We want to get you on the market, under contract, before we get to, let's say, mid-November. So that's kind of our window. What happens is the market typically slows down once we get to Thanksgiving because nobody wants to be under contract and moving and dealing with a lot of those things in the middle of holiday time. Those buyers start to say, I'll just wait till next year. So this is the fall market. We're in it right now. We want to get things moving. If you have more questions about all this data, we'd love to chat with you. You can find all of these videos on our YouTube channel at Ryan Kelly Group on YouTube. We post these weekly, but hopefully this was helpful. If you want to talk about the market in more detail, feel free to reach out to us. We'd be happy to chat with you. Otherwise, hope you enjoyed your 3-day weekend. Football season is here. Hook 'em, and we'll talk to you soon.